All right, so you are welcome to the lecture 2 of our advanced audit and assurance paper. Last week, we tried to understand the review as it appears in audit and assurance. We did some introductory, trying to define what an audit is, what assurance is, differentiating between the two. We try to understand the elements of assurance engagement, where we talked about the 5 key elements. We talked about the subject matter, which is the financial statement on which the auditor assets its true and fair view. We talked about the 3 parties involved, talking about those charged with governance who are responsible for preparation of financial statements. We talked about the assurance practitioner, who is the auditor who steps in to, gives a true and fair view. We also talked about the shareholders who were in need of the service of the auditor. Now we moved on to talk about the standards. The standards, we said that it is the basis for determination of the true and fairness of the financial statement. We talked about sufficient, appropriate evidence the auditor needs to be able to make his assertions. Then we talked about the audit report. The report with what the auditor generates in terms of how he communicates. We talked about the 2 main purposes of audit or assurance, where we talked about the obtainance of reasonable assurance, and number 2, we talked about the report that the auditor prepares. And we moved on to distinguish between what we call limited assurance and reasonable assurance. We did that. And we also discussed some ethical, legal regulations, where we talked about the international bodies, the IFAC, the IAASB, how standards are generated. All these things are audit and assurance knowledge-based things that we had to know. We stepped on into the legalities and defined who an auditor is. We talked about the appointment, the resignation, the right of an auditor, the remuneration of an auditor, and we did all those things. Now, the role of ICAG, we talked about BOG, SEC, NIC, and all those people. Those bodies that help in the regulation of audit profession. Now, today, my main focus will be the exam question. The first 20 mark of your exam question you'll be given a case. All right, so you'll be given a case, and in that case, they will ask you to discuss or identify what we call the professional and ethical considerations in the case. Consideration or issues in the case. So that is what you'll be given. Then the 2, usually this may go for 10 marks. Then the next thing that they will ask you is that suggest solutions. To the issues you have identified. All right, so these are your typical exam questions. All right, now you have to carefully analyze the question and break down the issues of professional and ethical consideration, and that is what we are going to look at. today. Now, I'm going to start with the ethical considerations. Now, when the question asks you about ethical consideration, there are 4 areas that you're going to look at. The 4 areas we will talk about: 1, the SAFI, threat to objectivity. So we will talk about SAFI. Or independence, threat to independence. And the acronym for that is SAFI, which you need to remember. All right. Then, not only that, you also will have to talk about the issues of confidentiality in the question. Confidentiality. Confidentiality. Then the next thing that you have to talk about will be what we call I of C, integrity of the client. Which we call I of C. Then the last thing will be C of I, conflict of interest. These are the things that you need to talk about when the question asks you what are the ethical considerations. So we're going to look at these things. And when the question also asks you about professional considerations or professional issues, the issues that you have to discuss in the case, the issues you have to discuss in the case, we will be talking about what we call money laundering. Then you also be talking about what we call professional liability. So the professional issues are outlined in, we'll first talk about practice management. And when we talk about practice management, we're going to be looking at how to obtain a client as an audit firm, and how to maintain the client. How to maintain the client. And that part is examined most times, how to maintain a client. In how to maintain a client, we're going to be looking at quality control. And the quality control, we will be discussing quality control at the firm level. We'll be discussing quality control on a specific assurance engagement. All right. Then another issue of professionalism is what we call money laundering. So we will discuss money laundering. Then the third one will be what we call professional liability. How do auditors handle the liability that comes with the work that they do? All right. So these, if you are able to understand these areas and able to actually make your point well stated, then it means that you are good to go, because you will need to consider all these things before you sign an engagement letter. And you realize that in the engagement letter, there are some things that must be there. We call them the shall things. And in also there are things that we say might be there. Okay, so the must and the might be there issues. Okay, so all these things that I've outlined sums up your 20 mark, your first 20 marks in your exam. So we're going to take them one by one, and we are going to deal with it. It is my focus to finish everything concerning these things today. All right, so that the next time we meet, we will start taking some cases and practice how we solve those questions in the exam. All right, so that is that. Now let's start with the threat to objectivity. As for this one, all the courses in the level 3 of both in the final level of both ACCA and ICA SEMA courses, they are all they all appear. You see this thing in advanced financial management. You see this thing in corporate reporting. You see these things in, what do you call it? Strategic case study. You see it in advanced taxation, strategic business reporting, all those things at various exams and at various levels. All right. So that is how we're going to approach it. So let's start with the ethical considerations over here. We're going to start with the SAFI. We talk about confidentiality, bit of interest, then we move on from there. Okay. So we come to our manual. You see the ethical consideration is outlined here in the chapter 3. So you have the IFA code of ethics, which is everywhere in your course. I think we've discussed it time and time again. So when we talk about integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. When we talk about integrity, what we are talking about is being honest. We are talking about being straightforward. All right. So that is what we mean. In all your professional dealings, in all your professional dealings. Okay, so as for these things, we've talked about it time and time again in all the various courses. Objectivity, we are saying that you should not be biased. All right, and we talk about not being under any influence. Okay, and those are the things we talk about. Professional competence and due care. Professional competence, here we are talking about knowledge. We are talking about skill. And so you need to upgrade yourself with all forms of knowledge that comes in circle of your profession. Like I always say, when I was doing ICA, revenue was governed by IAS 18. What do you call it? Leases were governed by IAS 17. These days, revenue is governed by IFRS 15, and leases are governed by IFRS 16. And so assuming that I'm given a job to do and I still go back and apply what I do or what I did when I was doing my ICA, you see, I'll be way, way, way off. And so since the standards are changing, I also have to upgrade myself, all right? And due diligence, we are talking about being diligent in all your work, all right? You don't do things haphazardly. You are just careful in delivery of your work. Confidentiality, we are talking about not disclosing information to third parties. All right, to third parties. You can only disclose when you are required to do so. So we will look at confidentiality. Don't forget, in the ethical consideration, I talked about the SAFI, and I also talk about confidentiality. So we will single out confidentiality and deal extensively with it. And when we talk about professional behavior, we say don't behave in any manner that will bring disrepute to the profession. Don't go and steal. Conduct yourself professionally, all right? So these are the things we talk about. Now, there are threats to these things that we have spoken about. All these things, there are threats. And the threats is what we've coined into the acronym of SAFI, all right? So in the exams, they might give you a case. You are supposed to be able to identify those threats and also deliver on safeguards. What I'm going to do is to start dealing with the threats and the safeguards that comes with it. So let's start with the SAFI. The SAFI, the first S is self-interest. The second S is self-review. A for advocacy, F for familiarity, and I for intimidation. So that is what you see here. All right, that is what you see here. These are threats to objectivity. Okay, so financial interests is what we are looking at. So we are going to look at all these things extensively. All right, so let's start with the self-interest rate. What is a self-interest rate? What is it all about? A self-interest rate, we say, is when the assurance team, a member of the assurance team, has a financial interest or some other interest in the client, all right? And we say that an interest that will be unprofessionally influenced, your judgment, because you are supposed to go and do the work objectively. And so if you have an interest there, then definitely it is very, very possible that you will be biased. And so these are the areas we look at when we talk about self-interest. And I expect you to be able to spot these things in any question, any case that will be given to you. So financial interest, talked about recruitment, you talk about fees, lowballing, employment with assurance staff and all those things. So let's pick them one by one and deal with it and also talk about their safeguards, all right, concurrently. So we talk about the example of self-interest. We said when you have financial interest, okay? So what do we mean by financial interest? When you have shares, okay, or you have a holding of beneficial interest in the form of any investment that can cause you to overlook some adjustments that happens in the entity. And so the safeguards that are applicable when the auditor or the assurance team or a member of the assurance team or the assurance firm has a financial interest, the safeguards that we will use in answering those questions are what you see here. It says that the parties listed below are not allowed to own a direct interest or an indirect material financial interest. Okay, so the caveat is what? Indirect material. But sometimes you all know that Ghana is a social society. Sometimes there will be relations somewhere, a relative who has done an investment in somewhere. But what we are talking about is that if it is direct, then that one is not allowed. If it is indirect, we need to check whether the indirectness is material or not. If it is not that substantial, you can let it go. All right. So that is that. And so we said that any indirect material interest in the client, these people, these listed people are not supposed to have such. Number one, we talk about the assurance firm, that is the audit firm itself, a member of the assurance team, and an immediate family member of the assurance team. Then we also talk about other partners and their family who practice in the same office as the engagement partner. All right. Also managers in the office. All these people are not meant to have a direct or an indirect material financial interest in the client that they are going to audit. Okay. Now, it is said that if they have such an interest, such a financial direct interest, then no safeguard will be sufficient. It means that what you need to do is to not to go and take the job at all. You have to resign from the job. There will be no safeguard that is sufficient. All right. But for members in the audit team, if you have such interest and it is not direct, then, for example, you have a pension scheme or any other immaterial interest, then the safeguards, some safeguards can apply. What are these safeguards? We are talking about disposing your interest. Okay, you have to dispose that interest. Again, you have to remove that individual from the team if required. Then what we say is that if any job has been done by those people who have indirect material interest, then what you are going to do is that you are going to let an independent partner review all the work that they have carried out. All right, so these are very, very important. Then we talk about business relations, having material financial interest in the form of a joint venture, all right, or any arrangement that combines two or more services of product from the assurance client and probably the assurance team itself or the assurance firm itself. All right. So we say that unless the interest is clearly insignificant, and that is the key, an assurance provider should not participate in such things as a joint venture, a partnership, or any of that sort. If any member of the audit team has such an interest, then that person should be removed from the team. It's very, very important. It's very, 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 very important. All right. Then if we talk about the arrangement, then it says that, however, if a firm or a member of a member, we are talking about an immediate or family member of that audit team has an interest in the entity. I mean, we are talking about an indirect form of interest. All right. Then there might not be such a great threat as we talk about. So generally speaking, we say that purchasing of goods and services from an assurance client on an arm's length transaction does not constitute a threat of independence. So if what you did with them is on an arm's length transaction, then it will not constitute what we call a threat. So you have to read the case very carefully and see the issues that are in the case. All right. It's very, very important.
Modern city campus with state of the art facilities that come. Yes, city campus.
Let's resume. All right. So we also want to talk about there are other things like distribution and marketing arrangements. All these things you have to check how direct and indirect it is and whether it is conducted on an arm's length transaction or not. All right, so that you'll be able to spot the threats. Now, when we come to employment, so assuming that audit team members normally go to offices of audit clients or assurance clients. Now, what happens is that sometimes when you go there, it is likely that you may have a conversation to be employed over there. Okay, please, if you have a question, you can ask.
Yes, sir. Please, the arm's length transaction. Can you please explain further what an arm's length transaction is?
Arm's length transaction is any transaction that happens between two knowledgeable market participants at a measurement date. What we mean is that, so let's say I'm going to buy a shoe.
Sir Tom.
I'm going to buy a shoe.
Sir Thomas.
Yes, please.
Simple put, we can say an exact market price that can be given to any other individual.
Exactly. So the market price. So so if let's say you are going to buy a shoe, we all know that when you go to the market, the shoe may cost like, these days shoes cost like 500 Ghana cedi, 550 Ghana cedis. Now, if you are buying it from a relative or something, you see the price, or somebody you are familiar with, the price, the person can say 350. This one is not an arm's length transaction. It is because you are related to the person. It is not the market value. You understand? There is some kind of padding on it. But when you go to the market, the thing is what? 500 cedis. And so 500 cedis is two knowledgeable market participants as a measurement date. The actual market price, all right, is what we are talking. Just like Mr. Danny explained, all right. So that is that. I hope it is clear.
Yes, sir. Yes.
All right. So that is that. Then we come to employment. Like I was explaining, sometimes when you go to the offices, some of them are likely to be poached. All right. So let's say I've gone to do audit in somebody's office, and whilst you are there, you realize that if the person wants you to do something in their favor, they will tell you that, oh, how much are you being paid at your audit firm? Can pay you double of that if you are willing to work with us. And all these things may get into your head and may affect your objectivity. All right. And it is a threat. It is a threat. And so we say that if that thing happens, then you have to notify your firm of such potential move. Please, okay. So if you will be moving to such a client, then it means what we are saying is that then you have to notify your audit firm of your potential move, all right, so that they will remove you from the team, okay? And any work that you have done, they will need an independent person to review it, because your judgment can be impaired, your professional skepticism can be impaired, all because they put in your head that probably they would want to employ you. Okay, so you would want to do anything possible so that you won't even talk about issues that ought to be talked about or ought to be raised. All right. Then we talk about recruitment services. Now you see, these days audit firms conduct non-assurance engagement for entities. An example of that is recruitment services. They recruit for people. All right. But the risk is that if you are recruiting for people, you have to check the level of the recruitment, because as you see here, we said that assurance providers must not make management decisions for clients. Their involvement could be limited to just review of shortlisting candidates and provide clients providing that the client has drawn up a criteria that upon which these employees ought to be selected. All right. Now, what is happening is that if you employ people for entities, let's say you have employed an account manager or finance manager for a company, and you are the same person going to audit that company, you realize that if something goes wrong, the thing will be like Adam and Eve. You are the one that gave me the apple. Yes. So this one, so it will go like you are the one that employed the person for us. So since auditors, these audit firms don't want to be, giving that branding, if there is anything wrong in the financial statement, they will tend to find a way to correct it themselves instead of bringing out the issues. And so therefore their judgment may be impaired. Now, what the safeguard is saying is this: for public entities, and this is important when talking about the safeguards of these threats, you need to distinguish between public entities and private entities. When we talk about a public entity, we are not talking about public sector. We are talking about those ones that can market their shares, all right, that trade their shares. So we are talking about PLCs, all right? Then when we talk about private companies, we are talking about those who do not trade their shares on the stock exchange market, all right? So these are what we are talking about. That is the difference. Okay. And so for public interest entities, audit firm must not provide the following in relation to a director or a senior manager. You must not search for the candidate. You must not check candidate's reference. It is not your job. if the entity you are auditing is a public company, then you must not engage in recruitment of anybody that is going to take a managerial position or a position that involves making decisions into the entity. Other than that, you'll be doing or auditing yourself because you are the one that positioned the person over there in the first place. All right, so that is that. Then we come to lowballing. What is lowballing? Lowballing is what we mean by quoting a significantly a lower fee for the assurance work that you are going to do as charged by your predecessor. And these things happen a lot. The immediate example I think you guys will be familiar with is that, you see, when you hire a mason or a contractor, let's say I've done construction before, a laborer work before in some time. And what I learned was that, in fact, in your junior high school, those who did pre-technical skills, where you talk about mixing a mortar or making a mortar, measure the quantity of sand onto the platform, measure the quantity of cement, spread it over the sand, mix it, and turn it over and over until a uniform color is obtained. Pour water into it and turn it over and over until a uniform paste is obtained. That is the mortar mixing process we learned in pre-technical skills in PHS. Long time. But in practice, you see, you come to the real world and you go there. What I saw was that they take 4 barrels of sand, and what they do is that they will add one bag of cement. And they will do the process that I just mentioned to you. So it is based on these things that they will charge. But you see, somebody will come and say, so if you do based on these things and you charge like 5,000 Ghana cedis for the construction of a 1-bedroom, whatever it is, then somebody will come and say, oh, this one is too expensive. Why do you pay that? You can give me 3,500. I will be able to do the job for you. Or for you to know that when the person is doing the measurement of the 4 barrels, for him, he's going to do like 6 barrels for 1 bag of cement. That is what we call lowballing. The person is charging a significantly lower price, and they do this thing just to get the job with the intention that, oh, okay, so when I get a job, maybe gradually I'll be increasing my figure. Now, here it says that the auditor must maintain a record such that the firm is able to demonstrate an appropriate staff and time they spent on the job, so they can use this time and staff to actually charge for the audit they are going to do. All right, so that is the key thing. That is the key thing. And when you are going to do the job, we will talk extensively about the quality control procedures that I mentioned. All right, so please, lowballing is not allowed. Not allowed. So when you see it in the case, this is your safeguard. Maintain records so that you can be able to charge based on the skills that you put in the job and based on the time that you spent on the job. All right. So the auditor's work should be based on these things, not doing lowballing just to get the job. All right. So that is that. Then we come to fees. Fees. All right. In the same vein, when you are charging your fees, fees should be dependent on the structure of the firm, the life cycle, and the significance of the client to the firm. So it happens so that what happens, the threat is that people look at their size and people look at the client that they are auditing. And so they check, oh, if this client is going to give me high money, then I'll have to do all things possible to keep the client. And it is dangerous, very, very dangerous. All right. So that is what we are trying to talk about here. So the safeguard is that you have to reduce your dependency on one client, that specific client. Because if you are so dependent on him, the person can intimidate you and you have to comply just because you get your very high proportion of fee from those people. Okay, that is what we are talking about. Now, very importantly, when it comes to public entity, the code, what we call the UK governance code, talks seriously about the total fee for a client. Now, it says that you, the audit firm, and this is what it's talking about. For an audit client that are public, the code states that where total fees of the client for the audit and any non-audit assurance represent more than 15% of the firm's total fee for 2 years consecutive, you have to disclose to those charged with governance. All right. So what we are talking about is that you are the audit firm. So as an audit firm, your audit fee should not be more than 15% for 2 consecutive years. So you can't have 15% of the auditor. Your revenue that you get should not be more than 15% from a client, whether assurance engagement or non-assurance engagement, for 2 consecutive years. So that is what we are talking about. So if it happens so, then you have to disclose those who are charged, those charged with governance. All right, it's very, very important. You cannot charge more than 15% continuously for 2 years. Please take note of that. And definitely these things are issues that you'll be spotting in your cases that will be given to you. All right. Because this amount to self-interest threat or intimidation threat. All right. Yes, question. Who is asking?
Yeah, this is Roland.
All right, I'm listening.
Please, with the things that you did mention, is it that it shouldn't form 15% of the audit firm's total revenue? Or
yes.
revenue?
Yes. The audit firm.
You're referring to the audit firm's total revenue?
Yes.
Okay. Thank you.
So like we are talking about here, total fees from clients for the audit or any assurance must not represent more than 15% of the. So here, what we are talking about, like you said, so you have to check. Oh, did you say the audit firm or the client?
I mean, the audit firm.
No, we are talking about the firm the firm.
Okay.
Yes.
So that is the firm that you are auditing.
So what we are referring to here is that, so let's say we have the audit firm and we have the client. Okay. So the auditor will go and charge what we are saying, that if the auditor is charging 15% of the firm's total fee, which firm are we talking about? The total fees that you'll be charging as an audit firm. So you audit client A, client B, client C, you'll be getting fees. Are you getting it? If one client contributes you, the auditor, if one client contributes 15% of you, the auditor, the audit firm, your total fees. All right. So it means that customer contributes a lot to you, and anything that you will do to keep them, you will do. And it is dangerous. So we are not talking about the client is revenue, it's not a fee. We are talking about the audit firm. All right. So the audit firm is our focus. Please, is that okay?
Okay, sir. Thank you very much.
All right. So that is that. And so we say that if the total fee significantly exceeds 15%, then post-issuance review may not be, it significantly exceeds the 15%. Then, okay, so here we talk about a review which can be done before the audit opinion on the second year financial statement is issued. So the first one, it exceeded, fine. We don't have a problem. But the second year, it is exceeding. All right.
Seton.
Yes, please.
Seton. Assuming A company is being audited by B company, and B company annual revenue income is let's say 6 million. That is, A is being audited by B, and A annual revenue is less than 6 million. Then it means B should not get more than 900,000 from A.
No, okay. So if I get you right, A is A the auditor?
A is a client.
Okay, so A is a client whose revenue is 6 million.
Yes.
And B is what?
B is the audit firm, the engagement partner.
Okay.
And B's annual income is let's say 6 million.
B's annual income is the 6 million, not A, right?
Yeah, that is B.
Okay. So it means that the money that B would take from A should not be more than 15% of this 6 million.
Exactly. That is 900,000.
Yes, so that is what we mean. We are talking about.
Okay. Then thank you for the clarity.
All right. Then you see, for the first year, it can go. But for the second year, it means that before you issue the audit report, somebody must do a review on that report because it is exceeding the 15%. But you see, we are saying that if in the second year you see that it's significantly exceeding the 15%, then this review is even not sufficient. It's even not sufficient. The post review is not sufficient. When we talk about post, it means that you've already reissued the thing out. So it means that the pre-review will be required. So you have to review the work again. And this is what we call code review. The post is the code review. The pre is what we call the hot review. All right. So it means that you need a hot review. If the thing exceeds 15%, you need to review it. All right. Before you issue the audit report, somebody must do the review. An independent person might have to do the review. All right. So that is why we call them external professional accountants or a regulatory body, because the 15% has been exceeded. And it is very dangerous because you will do anything to say true and fair view. You know, these days, auditors issue true and fair view, but companies are still collapsing. And it is an issue. It's an issue. It is because of all these threats that we talk about. And we talk about contingency fee. When we say contingency fee, what it means is a conditional fee, a fee that is conditioned on something. All right. And please, in audit, contingent fees are abolished. They are abolished. All right. So whenever you see a contingent fee, the safeguard is to withdraw from accepting that contingent fee. If you have to leave the entire audit, then you have to leave the entire audit. Contingency fee is abolished. All right, so that is that. All right. Now we talk about overdue fees. Some people too will be owing and they will say, oh, come and do another job for me. I'll add your old debt and pay you. All right. In a situation where there is overdue fee, we said that the auditor runs a risk. All right. And it's like you have given the client a loan, which is not supposed to be so. So the safeguard is that do not perform any further work with the client until outstanding fees are paid or there is a legal arrangement that has been done to clear the overdue fees. Don't pile up, all right? Don't pile up. We talk about gifts and hospitality. This one, I'll ask you a question based on your experiences. Unless the value of the gift is trivial and inconsequential, a non-assurance engagement is not supposed to accept the gift. You also have to document any offer of gift that was offered to you, even though you did not accept in your audit file. Let me ask you, those who have experience in these things, whom auditors have come to your office. I have experienced that thing on some regular basis. This is what I used to do. So auditors will come to my office and probably my my manager will say, oh, let's do some petty cash and buy some lunch for them when they come to the office, when they are doing their work. And most of the time, this is confession. So if the auditors are 5 and they will spend like 20 days, then it means that we need to get like 100 CDs, 100 for 20 days for 5 people, buying food for them at 30 Ghana cedis per person. So you raise 3,000. But I always add myself and make it 6, because I don't see why I should exclude myself. We are all doing the audit. You say we should do 2. I always add myself to make it 6 so that I can also benefit from the lunch. Now, my question to you is that, do you think it's appropriate for companies to be serving lunch or be buying lunch for the auditors? Is it not gift and hospitality issue? Yes, what do you think?
Sir Thomas.
Yes, please.
Issues of this sort come up almost every now and then.
Yes, that's what
entities try to treat these things. It's sometimes in their ledgers.
Yes.
Expenses.
Yes.
Assuming I'm going to do tax audit at that firm, and I see certain things, I'm going to add them back.
Yes, you have to.
Yes, I'm going to add them back because, fine, ethically it is not good. But you know, our system, the culture, demands that when someone comes to visit you, you should give water. So that is the brief of the entity doing that.
You heard the incoming, is it the incoming Attorney General?
Yes, I heard him right, sir.
That when you offer him a goat, you accept.
Yes.
His friends offer him a goat, you accept.
Yes, you see, our cultural setup says that you shouldn't neglect an offer, whether small or big, from someone.
Yeah.
So it's better you treat it in a different heading than making it gift and offer to, let's say, auditors. No, you can quote it. Let's say TNT.
But you are not doing faithful representation, which is a key characteristic of financial information.
But sir, you are saying that audit work is not 100%. You keep on saying it. I listen to you very well.
Yeah, I know.
I listen to you very well.
So these are the limitations to audit. These
exactly.
All right.
Thank you very much, sir.
Yeah. So it says that unless those gifts, so you can say it is trivial and inconsequential. So that is why you are accepting it. There is no consequence of that happening, influencing you in your financial statement. But you see, gifts are subjective. For some of the audit team members, the lunch they will get alone is safe haven for them. So like the way you explain it, also you have to explain it in a way like you have said. Sometimes there is cultural influence and all those things. But the key is that unless it is trivial and inconsequential, you should not accept it. All right. If the impact is small, you should not. It's not an issue. But if the impact of such is big, then you should. But whether you accept it or not, you are supposed to disclose it in your audit file. All right, the offer. All right. So that is that. We talk about loans and guarantee. In fact, the client is not supposed to give loans to the audit or any team member of the audit firm. So it is not allowed. However, if the firm that the client, the audit firm is auditing is a financial institution, loan giving is what they do. And so we said that if the firm or the audit team, the firm and the audit team or audit team members must not make loan, all right, to the client if the client is not a bank. But if the client is a bank, then it means that the loan must be offered at a commercial rate on commercial terms, all right, and it has to be disclosed, all right. So that is that. Arm's length, again, we are talking about, all right. But if it is not a financial institution or a bank, then loans granting is not acceptable. All right, we talk about serving as directors or officer of an audit client. An auditor should not serve in any position of making decision for the client. It's not done anywhere. So in such cases, you have to decline the offer, you have to resign. All right, so please take note of that. You should not, a partner or employee of assurance firm should not serve on the board. In fact, it is not just about a board. We are talking about any position that involves decision making. However, it may be acceptable if you are performing a company secretary role, where that company secretary role is just administrative. Just administrative. All right. You don't contribute to decision making, it's just administrative. If it is not only administrative, then you should not do such office. All right, so that is that. So that sums up what we call self-interest. Then we come to self-review. So self-review is just performing as an assurance engagement or an assurance work on something you have done yourself, the auditor has done, him or herself. And how do these things happen? Let's look at them. We will talk about the key areas involving preparing accounts for accounting records and financial statements. So you see, these days, some audit firms take the ledgers from clients and they prepare audit financial statements for them. It happens. It happens. I've had several issues and several practical evidences of this. It happens, especially in Ghana. I dare say that the audit work in Ghana are not properly regulated, sincerely speaking. I dare say that. And I think one of the issues is because of the dual role played by ICAG. You see, auditors are regulated by ICAG, but ICAG is the same people that produces the auditors. So there is a self-review threat in itself. Yes, they produce the accountants, they regulate the accountant. But when you go to UK, it's different. UK has a public interest oversight body who are not made up of accountants, but people with high ethical integrity who practice this oversight. But Ghana, it's not the same. I'm yet to see a department of ICAG that carries out these things. Probably a research has to be conducted in this area. All right, so auditors these days, they prepare, they actually prepare, they prepare. But you see, for any client, the assurance firm must not be allowed to determine the journal entries or changes in entities journal entries without the client's approval. So I have had an experience with Deloitte for like 3 years when I was in charge of financials of a company. What they do is that they will ask you to propose your journal yourself. They won't do that for you. So they will ask you to propose your own journal to correct your errors. All right. We are also talking about authorization and approve transactions. They all have to be done by the entity themselves. So there is no way the auditor should prepare financial statement. But here, what I will tell you is that you have to make a distinction between the private company and a public company. For public company, it is a no-no. You cannot prepare the account and review the account. It's not allowed. All right, you cannot do that. It's not allowed anywhere. But for private companies, and I think Deloitte does this a lot, there will be a department in the Deloitte firm who will actually help in preparation of the account. We call those things a non-assurance engagement. Then there will be the assurance department who will go and audit the account. All right, and it only happens for private companies. All right. For public companies, you cannot do that. It is a no. All right. You cannot have a department preparing an account and another department going to do the assurance. So please take note of that. All right. take note of that. So like I said, when discussing the issues in the question, check in the question if the company in question or the client in question is a private company or a public company. All right, then we talk about valuation services. Of course, you people have learned FR and corporate reporting. We always talk about fair value, fair value, fair value. The same thing that I mentioned, you have to split the thing, the entity into public company and private company. All right, so over here. Now for public company, here we said that firms should not, in fact, for public interest companies, you cannot do that. You cannot perform evaluation service. What do I mean by evaluation service? We are talking about revaluations. All right, where you go there and do revaluations of the PPs, the IPs, the IS tools, the inventories, and all those things. For a public company, no, it's not done. It's not done. But for a private company, a department can do that, and the assurance department can also go and do the assurance. All right. So we say here that if the evaluation is for an immaterial matter, the audit firm should apply safeguards, and that is the safeguards we are talking about. A second review is needed. All right. So you use separate personnel for private companies. That is what I'm saying. So it's a separate department for the valuation, then a separate department for the assurance. All right. And it happens only for public companies. For, private companies. For public companies, it is not allowed. All right. So please take note of that. We move on to what we call taxation services. And the taxation services are classified into 4. So here, I'm going to talk about, first one, we are going to talk about tax return preparation, the return, filing of the return. Now, for filing of the return, it is allowed so far as the management of the company will take responsibility. All right. So, because filing has nothing to do with threat of independence. Okay. So long as management will take responsibility, the filing, the return preparation is not a problem you can do for them, whether private or public. Now, but when it comes to computation, you see, the computation affects figures in financial statements, and that is the key. It affects figures. You know, the tax element in the P&L is from computation. And so in a public company, you are not allowed to prepare tax computation for the client. All right. So please, a firm cannot, for a listed company, you cannot. But for a private company, it is acceptable. Like I said, one department will do the tax computation and put it in the P&L for the entity. Then the other assurance team members can go and audit that. You see, even that one, there is a threat. It happens. So in a multinational I worked with, it was a private company. And so Deloitte had a department that prepared the financial statements, and it included the tax computation. But when the assurance team members come and they see the tax figure, they don't even audit it. Why? Because it was done by a department of their own. So that is it's a self-review. But because the company is a private company and the code allows it, that is what they do. All right. Then apart from the computation, another issue is tax planning and advisory. Tax planning and advisory. As for tax planning and advisory, it is acceptable if it is clearly supported by the authorities, like GRA supports it. All right. But if the effectiveness of the tax advice depends on a particular accounting treatment in the financial statement, please, that is where it should not be provided. That is where it should not be provided. All right. So please take note of that. As for dispute resolution, you should not even represent your client in terms of the dispute resolution if the figures are material. All right. So you are not supposed to. So you will need tax professionals to go and do that, not the audit team members. All right. And sometimes to internal audits are outsourced. Okay, internal audits are outsourced. But for public company, it is not allowed. It is not allowed at all. You cannot do that. But for private company, a department can go and do it. Then another department can do the assurance. All right. So that is how we talk the threats and the safeguards are supposed to be added to. Corporate finance, we have certain aspects of corporate finance that will create a self-review threat that cannot be reduced by any safeguard. And so we say that assurance firms are not allowed to promote or deal in any underwriting of client shares. All right. So they are also not allowed to commit the assurance client to any terms of action. All right. So please, these are things that you are supposed to know. We come to advocacy. What is advocacy? Advocacy, we talk about promoting or advocating the client business. As an auditor, it's not your job to promote a client's business. It is not in your place to do that. All right. So we talk about acting as an advocate for a client in litigation, representing them in a court case. You are not supposed to. You are not supposed to in any way comment publicly on events about a client. You are not supposed to. You are not supposed to also promote the shares of a listed entity. It is not allowed. All right. And so here the safeguards are that we said that the auditor must appear independent in fact and indeed, and also independence in appearance. What do we mean? The state of mind of the auditor is very, very important for professional skepticism. All right. And so he must appear objectively, in fact or indeed. All right. Then we also talk about independence in appearance. Here we are looking at issues of integrity and objectivity so that professional skepticism will not be compromised. Okay. So how the auditor is, there should not be any form of relations or informed a third party of any relevant information that says that, oh, this guy is afflicted to our entity. You have to be so distinct from the entity that you are going to audit. Familiarity. Familiarity, we talk about long association. You've heard of the 666, right? 666. So you can audit a client for 6 years. You have to stay for a cooling period of 6 years. Then after the cooling period of 6 years, you can come back. All right. So that is how it is. So you cannot be the same auditor for a client for 7 years these days. In fact, in Ghana, it is 6 years, but I think in UK, it is 5 years. All right. So that it will solve the issue of the long association. But I think even within 3 years, long association can be formed. It happens. So in those periods, you have to be changing the team members. Even in the 6 years, you have to be changing the team members. It's very, very important. Very, very, very important. All right. So that is that. So you see clearly long association, the issues spelled out over here. Okay, so we have long association. Rotation is very, very important. So like I said, know that the companies as audit partners may have to rotate off every 6 years. All right, so take note of that. All right, so that is familiarity. So if you have a relative that is there, employment with the staff, all those things, you have to also provide the safeguards. If you have a close family, then please you have to remove yourself. All right, so all these things. Then intimidation can be classified into three. We talk about threat of dismissal. You see, sometimes the client threatens that they will dismiss the audit firm if they don't do the work in a way they want it to go. All right, it's very, very important. And also what we call, so this one is if there's a disagreement and the threat that we will not give you contract for other non-assurance engagement since you are not doing the audit the way we want it. It's also a threat. There is also pressure to agree with clients because of the client has more experience. And these things, it happens a lot. My former boss used to do that a lot, especially when you come there and you are asking questions about something he feels you should already be having. So when they come, you know, they ask for, I mean, the routine of the entity, like the things, the entity that every year they come, they ask. He will tell you that, why don't you have a permanent file? You keep these things. You are an auditor, you are supposed to have all these things down. All right. So the way he would do it, if you mess up an entry, a transaction, he'll tell you that you are an auditor. You don't know IAS 2 says that inventory is measured according to lower of cost and net realizable value, just to intimidate you. All right, because he has superior knowledge than you. All right. So all these things, when it happens, the safeguard are that remove that individual who is intimidated from the team and have a professional to review their work. All right. So please, that is that. In all, we are saying that when you have a threat, identify the threat, assess the threat. When we say assessment in audit, what we are trying to ask is that what is the relationship? What is the relationship between the threat and the financial statement? What is the relationship? What figure is it affecting in the financial statement? Because from the element of assurance engagement, it is the financial statement we are going to assess the true and fair view on. So what is the relationship? So that is what you do. And is there any safeguards? If there is, you have to eliminate the threat or reduce it to a very acceptable level. So that is what you do. All right. Okay, and this is what you are going to do in your exams. You are going to identify the threat, assess the threat, and apply the safeguard. That is what you'll be doing in your exams. All right. So safeguards are actions that you take to eliminate the threat or reduce it to an acceptable level. So we have quality control threats, safeguards, which we will talk about when we are talking about performance practice management. And most of them are coming from having professional CPDs, what we call continuous professional development. This one is professional competence and UK. You have to upgrade yourself on the standard. Corporate governance we discussed last week. All right, all of them are what we call quality control. And we also have the safeguards in the environment, which differ from the firm-wide and also we are talking about on the specific job. And that is what we've talked about in the tables that we shown. All right, so that is the SAFI. Then we come to confidentiality. Don't forget, I outlined for you that the ethical things that we are looking at is the SAFI, which we've done now. Then we will talk about confidentiality. Then I of C, integrity of client. So I of C. Then C, what is C of I? What did I say C of I is about? Yes.
Conflict of interest.
Conflict of interest. All right. So these are the ethical issues. Conflict of interest. Okay, so that is that. Let's look at C, confidentiality. Confidentiality. All right. So generally speaking, you see that there are times we said that do not disclose information out to third parties, but confidentiality has a limit. All right, and that is where we need to focus on. Sincerely speaking, this manual that I've done for you, if you take care and read accordingly, even if you miss class, you pass your paper. I've taken time to do it. Very soon I'll be publishing it out. You people are having it freehand. All right, so the general rule is simple. Do not disclose client information to anybody. That's the general rule. However, there are exceptions. If you remember in corporate reporting, when we were talking about the ethics, we said that there are places where it is permitted, required, and there are places where you have to seek permission to disclose. There are places where you are required to disclose, you don't need permission. There are instances where you will need permission. So you don't have to disclose. However, where the laws requires you to disclose, example, money laundering, and let me add terrorism. If the client is doing anything terrorism, you don't need their consent. You are required. The law requires you to disclose it. And you can also disclose when you have permission, all right? And if the thing is deemed in public interest, you have to disclose it. You have to disclose it without permission. Where ICAG are investigating an audit client, wherever there is a doubt, a consultation with them. So what I want to say here specifically is that sometimes you have to seek regulatory advice, but each time you say that, add this phrase, not compromising on quality, on confidentiality, sorry, not compromising on confidentiality. So it is very important, and take note of this. Sometimes people say that, oh, because I don't want to be trouble, I want to resign. Resigning from a client does not mean the auditor is now free to disclose any information he wishes. So please, that does not mean that if you resign, you are now free to disclose. You are not. You are not. In fact, some clients will let you sign some agreement that even if you leave the entity, in foreign land, lawyers, when you leave, you are supposed to sign what you cannot compete. You cannot. Some will say you will not even practice law for 1 year when you leave them. So that is that in the jurisdiction that they are in. So if they are, let's say in New York, if you resign from that entity that is in New York, you cannot practice law in New York for 1 year. You have to wait for 1 year, unless you leave New York and go to another place. All right. So that is that. Then conflict of interest. Conflict of interest. What is conflict of interest? Conflict of interest is where you have two clients. You, as an audit entity, you have two clients. All right. So let me give you an example. So let's say PwC, I don't know, but I think it's KPMG, will be the auditor for Apple and Samsung. It's a serious conflict of interest. Very, very serious, because any information about Apple is a competitive advantage to Samsung. Any information here can be a competitive advantage to Apple. So you have to be very, 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 very careful. You have to be very, very, very careful. So that is that. So what do you do? What will be the safeguard? What do you do in this situation? And that is what we want to look at. What the auditor is supposed to do when you have two clients of which there seemingly be a conflict of interest. Okay, so it says that the most common is between two clients, where what is good for one client becomes what is bad for the other. That the auditor cannot help one client without harming the other. It's very impossible. It's an impossible situation. So what do you do in these situations as an audit firm? What happens? What do you do? Okay, and that is what we want to look at. So it says that before you accept the new client, you have to consider if there is any likelihood of conflict of interest. All right, it may be a very best situation to refuse those offers because of the conflict of interest. But where a conflict is possible, then it means that you have to separate the team. So, and the best way to do that is that if you have, let's say, KPMG Ghana, KPMG Nigeria, you can use the Nigerian team to audit the Samsung and use the Ghana team to audit the Apple. All right, that is what you can do. That is what you can do. Because you cannot make two Ghana entities be in the same office. I mean, data information will flow, and you have to be very, very careful. Information will flow from one person to the other. So you have to be very, very, very careful. All right. So that is that. Then we also say that, so that is what I'm talking about. Separate team, separate office, different partner to head each team, a third party to oversee the teams, all right, that are kept apart, all right. So stricter confidentiality rules, all right, so that, and you have to inform the two clients that, please, I'm the same person doing Samsung. You tell Apple that you are the same person doing Samsung. You tell Samsung that you are the same person doing Apple, so that they'll know. Worst case scenario, you can consider resigning from one of them or both of them. So that is what you do, the safeguards, when there is what we call conflict of interest. All right. So please take note of that. Take note of that. All right. Then we come to the last one, which we call the integrity of clients. Integrity of clients, we look at ISA 250 and ISA 240. Those are the areas that we will be looking at. ISA 250 is about laws and regulations. All right, laws and regulations. And ISA 240 is about, what do you call it? Fraud and error. So ISA 250, laws and regulations, you have to know that it is not the job of the auditor to ensure compliance. So please, it is not the job of the auditor to ensure compliance of the entity. No, it is the entity job to know the law. Mr. Amos. All right. Mr. Amos. All right. So what we are saying is that you, the auditor, what we are saying is that you cannot understand, you cannot know and understand every law that pertains to the client. But you see, when we talk about ISA 315, it talks about understanding the entity and its environment. And one of the things that it talks about is to understand the laws that surrounds the entity. All right. So, but you see, you cannot know all the laws. It is good if you know all the laws, but you cannot know all the laws. And so we said that the laws and regulations are supposed to be the job of those charged with management. That is what they are supposed to do, making sure that their entity adhere to it. But if they don't adhere, why is the auditor interested? The auditor is interested because there are issues such as fines if the people are caught. And sometimes they have to make provisions because of their non-compliance. They will be taken to court. They have to make provisions. And issues about going concern. If you don't know something like tax, if you don't comply at some point, there will be cessation of assets and all those things. Now, the auditor is auditing the financial statements. Understand that. And you see, we said that identify the threat and assess the threat. Fines will be an expense in the books of the entity. So that is why the auditor is interested. Provisions, IAS 37, standards, elements of assurance engagement, standards, we need that. Who can tell me the standard for going concern? The accounting standard for going concern.
IAS1.
IAS1. So you see, because of this thing, you see, you, the auditor, you are going to express your view on the true and fairness of the financial statement. And you see, if the standards are not adhered to, then it means that the financial statement may not exhibit true and fair. That is why, in terms of laws and regulations, the auditor is interested. So these are the reasons why. The figures affect the non-compliance, affect figures in the financial statement. All right, so please take note of that. So what does the auditor need to do? ISA 250 talks about consideration to law and order and requires the auditor to, number one, obtain general understanding. I talked about ISA 315. All right. Number two, you also talk about gathering sufficient appropriate evidence. Okay. So we are talking about how these things may affect the material amount and disclosures. IAS1 is about disclosures. IAS 37 is about material amount, the provisions that they can make in the financial statement. So you see, that is where we are building the audit to. Mind you, I always tell you that you cannot do audit and assurance or advanced audit and assurance without having no knowledge about the standards. If you don't, you have missed 20 marks already. So you will need to apply the standards, okay? So that is that. So we said that you have to perform audit procedures, make inquiries and all those things, written representation. Before the audit starts, there's a written representation from the management that says that, oh, as for we comply to all the laws. So that if you check and they don't comply, there is an issue, all right? So that is that. That is that. So reporting is part of what we call the issues in ISA 250. And it says that if you see a breach, you have to report the breach to management, all right? So that is that. It's their ultimate responsibility, not the auditor. So if there is a breach, you have to report it to them. But if the breach involves the management themselves, then please report it to who? The audit committee. That is the levels. That is the levels. But if the breach also involves the audit committee, I mean the entire board of directors, then it means that you consider the client in terms of legal, you seek a legal advice and consider the lack of integrity of the client. Are you getting it? I of C. That is what we are talking about. Consider the effect of the breach on the accuracy of the financial statement. So like I said, fines, which might affect IAS 37, and breaches, which might affect what? IAS1 going concern. All right, so please take note of that. Then we come to ISA 240. ISA 240 is about fraud and error. The same thing applies. It is not the auditor's job to detect fraud and error. That is a misconception. What is fraud? We are talking about the use of deception to gain. All right. So fraud is classified under fraudulent reporting and misappropriation of funds, embezzlement. In fact, when you even use company car for personal use, it is fraud. It's fraud under the definition of misappropriation. All right. So take note of that. Those in public sector. Those in public sector. All right, so that is that. Okay, then we talk about irregularities. What is the auditor's responsibility? And that is what we are interested in, the auditor's responsibility for fraud when it happens. So it is the job of the board of directors to prevent and detect fraud. It is not the job of the auditor. But the auditor is interested. Why? Because again, fraud affects figures in the financial statement. Errors affect figures in the financial statement. All right. So here, the key is that you have to exercise professional skepticism. What is professional skepticism? We explained in our first meeting that we are talking about the auditor having openness of mind to the extent that people can make mistakes, all right? So a questioning mind and openness to the fact that people can make mistakes in the financial statement for which they have to question. All right. So in planning, the auditor needs to plan in such a way that he will be able to identify all material misstatements. And most importantly, so we say number one, professional skepticism. Number two, you need to relate the fraud and error to the financial statement. You need to relate it, okay, and find out the impact of it. Then what you do is that you report it, okay? So always report. The reporting happens the same way as the laws and regulations. So you report if a lower staff is the one causing the fraudulent activity, report to management. If management is involved, audit committee. If audit the whole board of directors, then you have to consider that it is the integrity of the client in general. All right, so that is that. As for expectation gap, you understand what people think auditors should do, which is the detection of fraud and the punishment of fraud and what auditors actually do. This is the problem we face in our nation, where anytime the auditor general does his work, you see irregularities, but there is nothing he can do because his job is limited to expression of opinion. There is nothing aside that he can do. It now becomes the job of the auditor, the attorney general, to take it on. Okay, so please, that is the misconception. There is nothing the auditor general can do apart from expressing his opinion. He's an external auditor. So please, to summarize it up, when you have issues of fraud, what you need to do, we talk about professional skepticism, then relate the error to the financial statement, the fraud or error to the financial statement. Report, all right, reporting it, okay, to the appropriate thing, then documenting it is very, very important. All right, so that is that. That solves this part that we want to talk about. All right, so very, very important. That solves the part that we want to talk about. All right. So